The standard 60-40 mix has been the reliable engine for American retirement for decades. But in 2026, those mechanical rules are running into a new set of economic variables that traditional index fund strategies weren't designed to handle. The American economy is currently caught between two opposing forces. We are experiencing the largest wave of government fiscal stimulus in recent history, occurring at the exact same time as a restrictive, high-interest rate monetary tightening cycle. On one side, Washington is keeping the pressure on the gas pedal. Between the Inflation Reduction Act and the infrastructure law, hundreds of billions of dollars are flowing into the economy to build out a green energy grid and domestic manufacturing. Simultaneously, the Federal Reserve is slamming the brakes. Jerome Powell has kept the cost of borrowing at a two-decade high, specifically to drain liquidity and bring inflation back down to target. This creates a paradox. One hand of the government is forcing a demand shock from new infrastructure, while the other, the Fed, is choking off the capital required to build it. The result is a structural squeeze on the energy sector and the broader macroeconomy. Utility-scale wind and solar projects are uniquely sensitive to these rates. Unlike a tech company, an energy grid requires massive upfront spending on physical hardware, and it takes years of operation before the project generates enough revenue to pay back its initial debt. This chart displays a discounted cash flow model. At 1% capital cost, a solar farm's earnings justify the build. At 5.5%, present value drops, making projects unviable. Construction stalls. Private capital retreats, leaving a gap between government infrastructure goals and actual energy produced. By keeping borrowing costs high, the Fed is effectively slowing the expansion of the energy supply. This prevents the very infrastructure build-out that would eventually lower costs for consumers, locking the system into a cycle of elevated prices. This dynamic is fueling greenflation, the measurable price inflation of the raw materials and supply chains required for the energy transition. To replace a fossil fuel-based grid, you need vast quantities of physical matter. Transitioning to EV infrastructure and solar generation requires millions of tons of copper, lithium, cobalt, and silver. This supply is fundamentally inelastic. While software can scale in weeks, it takes an average of 16 years to permit and build a new copper or lithium mine. Mining output cannot simply be toggled on to meet sudden demand. Silver is particularly critical here. It is the most efficient electrical conductor on the planet, making it the primary conductive backbone within the solar panels themselves. The supply side is also fragile. 60% of the world's silver is produced as a byproduct of mining for other metals like lead and zinc, meaning silver production is hostage to the economics of entirely different industries. This chart shows global silver supply remaining largely flat. When you overlay the rising industrial demand from 5G, electric vehicles, and solar panels, you can see a widening structural deficit that is projected to last for years. You can subsidize demand with trillions of dollars, but you cannot subsidize the physical existence of more copper or silver. Chasing a fixed amount of raw material with more currency guarantees that the cost of the transition will continue to rise. Gold is following a different logic. Its price action isn't tied to the industrial bottlenecks of the green transition. Instead, it's responding to the record-high U.S. federal deficit. As government spending remains at multi-decade highs, the perceived risk of holding U.S. debt is increasing for large global players. Global central banks are now accumulating gold reserves at the fastest pace since the 1960s. They are diversifying away from U.S. treasuries to reduce their exposure to the dollar. Central bank accumulation is the primary force behind this multi-year bull run, as sovereign nations structurally hedge against long-term monetary instability. Institutional investors are already shifting their portfolios to account for this macro squeeze. Rather than holding long-duration bonds that lose value as rates stay elevated, capital rotates into ultra-short treasury instruments. This shows the yield on 3-month T-bills near 5%. Large funds use these as a safe harbor, capturing high yields with minimal duration risk. There's a parallel move into hard commodities. Managers are securing direct exposure to gold and silver bullion, or leveraging the miners that stand to profit from the industrial and monetary demand. This same logic is driving a rotation in the stock market. High multiple tech companies are struggling under the weight of higher discount rates, causing capital to flow toward value stocks. companies that generate real cash flow today rather than promising it years from now. In an environment where the cost of money is high and material supply is low, Wall Street prioritizes tangible, inflation-resilient assets over speculative future growth. Structural greenflation, persistent government spending, and a restrictive Federal Reserve are now the primary constraints on the American economy. This environment necessitates a realignment toward real assets, shorter duration, and companies with immediate cash flow. The institutional shift toward this new reality is already well underway. You can either understand these structural changes and reposition accordingly, or wait for a return to cheap capital that the data suggests is not coming.